Okay, let's get the show going, guys. We're going to have some fun tonight. Grab a chair, grab your drink. Thanks for coming out on this beautiful Calgary evening where you could be doing lots of other things, but you're keen to learn, and we appreciate that very much. So welcome to Launch Class. Today's lesson 14 called Investing Fundamentals. I happen to be an investment advisor, so I've been in this business for 21 years. So we're going to get a little deeper than we necessarily need to, but we're going to hopefully cover some good ground. Technology's working, excellent. So welcome, we're glad you're here. And our coaches are here for you. This launch class is, we're all voluntary. I'm Coach Al, other coaches have a similar name tag. And we envision trying to help young adults get more successfully launched in their careers, family, investing, money management, health and fitness, things like that. Things that we wish we knew or were taught when we were young adults in your age. So hopefully you find it useful, but also help us to help you. This is about you tonight. We want to make it as valuable as possible. So there's surveys that go with your little handouts there. Give us an idea of what you think would be helpful topics for the future that we can cover. Because it's truly, it's about helping you to get more successfully launched, get a more successful life, great family, improve quality of life for all Albertans. That's really what we want to do. So we often refer to this little 7 areas life choices diagram here. This is something that was developed in a men's group that some of us were part of a couple of years ago, and we thought it was helpful. We thought, wouldn't it be good to take some of this information to young adults and have kind of a framework to look at life and analyze life. And if you find yourself not necessarily happy where things are at, you can look at this and say, oh, maybe I'll work on that part of my life. So 7 areas of life: spiritual, family, social, financial, career, physical, mental. We're talking about financial today, but the main idea here is here's us, or you, and we have choices to make. When we make choices, we can go towards the problem or the goal, or we can avoid it. We know that. We don't feel like doing the work sometimes. We don't feel like dealing with relational problems all the time, do we? So this is kind of how life is. We have God who made us, pushing up on us, encouraging us to go in the right direction. We have life squeezing down on us, and we have to make choices, right? We know that, and that's why we're here. That's why you're here. So we don't want to encourage escape, which is taking off and going for fun, food, pleasure, shopping, etc., etc. None of those things are bad in themselves, but they're not really great if we have problems over here that we're not dealing with. For example, let's just say you're not happy with, you're 20 years old and you're not sure where you want to do. What do you want to do for a career? Well, let's go put some effort in, do some research. Our coaches are here to help you do that, to try to figure that out. Let's just say you're having some relational challenges. Let's not run away from the problem, let's go towards the problem. We call this the corridor of fear, uncertainty, and doubt, because if we don't have someone helping us, we're not likely to do it. The thing that we're excited about, we want to help you understand, is when you do that, you go towards the problem or the goal, better career, things like that, God will meet you there. That's just how we understand life to work. And so this is not necessarily a church thing, this is practical application, life coaching, if you will. So that's the foundation. What we're really after is kind of between our ears. We're after lasting peace, happiness, confidence, and fulfillment. We understand that. Kind of growing up and hanging out with our peers, we think that a new car, new girlfriend, new career will get that, but we find it's not lasting. A little bit more money, it's not lasting. Lasting peace, happiness, confidence, and fulfillment come from getting some success, some confidence, some skill in these 7 areas. And that's what we want to help you do. We're passionate about that. It's helped us a lot, and we want to pass it on. So that's the foundation of Launch Class. Today, as you know, it's about the financial side of things. We talked about money management a few lessons ago. Today is going a bit deeper, talking about investments. Last time we were together, 2 weeks ago, we talked about health and fitness strategies part 2. Check that on the website if you haven't already. This week, investing fundamentals. So let's dive into it. Yeah, it's working. Okay, so there's only 2 pages of fundamentals that we have here. We tend to have the belief that life is pretty fair. The most important things in life, you don't have to be a rocket scientist to figure it out. Anybody can grasp these concepts. And this is a simple one right here. Start to save and invest as young as possible. That goes against the grain. We want to spend money. We want to live today. We don't want to call it delayed gratification. We want to live today. That's our human nature. So one of the most important things we can do for lifetime success, and success in all 7 areas, is to start saving and investing as young as possible. We're not going to get into the details on how to do that today. That was a little bit on the money management one. But to gain the power of compounding working for you and gain experience that will serve you well over time. In other words, you start saving, let's just say you save up $10,000. You invest it. We're going to talk about that today a little bit. But just going through that process, saving and investing, you learn a lot. And we'll touch on a lot of areas of investing today, but you don't need to understand them all. Grasp a few of the key things, and it will serve you well for your whole life. So here's an example of the power of compounding. $400 a month for 40 years at 7% per year compounding will end up over $1 million in 40 years. So you've invested $192,000 in principal dollars at $400 a month, and you end up with over $1 million in 40 years. That 7% a year is a long-term average for the stock market. That's why we picked that number. It's a long-term average kind of for inflation as well. That's why we picked that number. So I'm going to click on this this link here and go to this Nerd Wallet, show you the compounding interest calculator, where I got this from, in a second. First, I'm going to talk about the next point, because there's going to be 2 slides on the internet here. What most advisors, people like me, don't tell you is that average inflation is close to that same 7% rate. Now, if inflation was only 2 or 3%, like our governments tell us, then you would actually be getting ahead with that 7% per year compounding on your investments. But if inflation is the same 7% per year number, you're actually not getting ahead. That compound interest on your investments, it's the same buying power in 10 years, and 20 years, and 30 years, and 40 years, if inflation is truly in that 7% range. And I'm going to show you, there's many sources on the net and economists that talk about this idea. So it's one of the little secrets that is like kind of a negative, so it's not talked about, but it's important for us to understand that what real inflation is. So now I'm going to go to, hopefully this works here, I'm going to go to the internet, and I didn't think that was going to work quite that way, so I'm going to shut down the slideshow. And are we there? We will be there in a second. So this is the compound interest calculator. Oh, technology. Okay, I've done this before. Yep. There it is. Yay! So this link is on your, it'll be on the PowerPoint on the website. It's on your handout as well, but you don't want to type all those letters. So this is just a compound interest calculator. You input whatever you want in terms of initial deposit, contributions, investment time, rate of return. That's what I did with the $400 a month, 40 years, 7% per year. Comes out to over $1 million. And you can play with that however you like. So that's that first example. A little tool there, a little help. But if you get thinking about these things at a young age, it'll serve you really well. This is a website very, very few investment advisors will talk about. But the top economists do. It's called Shadow Government Statistics, and by a guy named John Williams. And John Williams takes exception to the government's jobs numbers and the government's inflation numbers. Bottom line, he says they lie about them because there's a conflict of interest there. You see, everybody's pensions are tied to inflation. Canada pension is tied to inflation. So if they can tie that to a low number for inflation, that'll cost the government a lot less, but your pensions will shrink relative to real inflation. If real inflation is, like John says, 7%. I'm gonna show you exactly what I mean by that. So this is his inflation page. He's got a different page on jobs. So this little chart here, what he says here is if we calculate inflation today the way we did in 1980, we'd be running at about, it looks like 14% inflation right now, whereas the government says it's about 5. Historically, the government said it's about 2.5, 2, but it's really come up lately, as you guys know. The idea here is back in 1980, they left everything in those inflation calculations, and volatile or not, they leave them in. But since then, what they've been doing is they take housing out because they say it's too volatile, then they sneak it back in. They take energy out, they say it's too volatile, then they sneak it back in later. Food, they sneak it out, too volatile, sneak it back in later. That's how you get the red line. The red line is the consumer price index that the government tells us. The blue line is actual inflation if we calculated it the way we did back in 1980, the more honest way. And why do we talk about this? Well, for one thing, it tells us if real inflation is running at 14%, if we're not getting 14% return, which we're not, generally speaking, then we're falling behind every year, right? If inflation is 7%, like we talked about in that example, if inflation long-term average is 7%, which John Williams says it is, and we're not getting 7% return average on our investments, then we're falling behind. Our buying power is falling behind inflation. So that's the first thing we can glean from this is we actually need to get a return. GICs that pay 1.5% aren't going to cut it. We're going to really fall back. If we fell back, the other example is at 7%, prices double every 10 years. And that actually creates an advantage for, say, RRSPs, TFSAs. There's a real big advantage in RSPs and TFSAs. I'll touch on it later, but the benefit of them is not that you get a tax break today. It's not that. The greater benefit is you have compound growth tax-free over many, many years. So if you can defer a tax bill by 10 years at 7% per year inflation, you've cut that tax bill in half. That's what RRSPs and TFSAs do. If you can cut it, if you can defer it by 20 years, which they do effectively, you've cut it in half again. So now you've cut your tax bill by 75% by using your RRSP and your TFSA. So those are tools that the government has given us that help us a lot. Okay, so we'll shut this down, and we'll have to fire this PowerPoint back up. Okay. We won't have to do that again. Hopefully this works without waiting too long. Yay! Okay. Sorry guys. Okay, so lastly, the fourth point there. It's critical, even though inflation's running at, say, an average of 7%, and your returns on your investments are averaging 7%, therefore you're not really getting ahead of inflation by saving and investing. It's still critical to save and invest and start as young as possible. Obviously for retirement, so you have some security in retirement, but it opens up opportunities, i.e. get your money working for you. Eventually you can live off your investments and the returns on your investments, but also perhaps start a business. Gives you choices. Say about $50,000. A lot of times you can start a business with that, 100,000, whatever it is. So you create options for yourself. If you are in a job you don't like, you have some savings, you can say, see ya, I'm out of here. But if you have no savings, guess what? You're stuck, right? So start saving and investing as young as possible to give yourself choices. Okay, types of investments. Here we go. Many, many types of investments. The last point on this slide says you don't need them all, so don't worry about if you don't understand them all. GICs are what you get at the banks, guaranteed investment certificates, guaranteed by the bank. That's what you'd call essentially no risk if it's a big bank, right? So I think they're running at about 1.5% right now. And like I say, all you're doing is protecting your capital, but you're not growing it with essentially GIC, especially if inflation is running at 14%. Then you get into stocks. Public stocks, that's the public markets. Most people are familiar with the stock market, but stocks, just you buy a piece of a company. You can do that in the public market, or you can do it privately. I'm not going to get into details today, but I just want to touch on all the different types of investments so you have a reference. Take this with you. It'll be on the website, a reference for going forward. So bonds. Typically, companies make available stocks and bonds. Big public companies, they make available stocks and bonds. When they sell you a stock, they're selling you a percentage ownership in that company. And the price per share fluctuates on the stock market based on supply and demand and the earnings of the company, the revenue of the company. Bonds, when you buy a bond, the company is you're lending the company money. They give you a bond, which is a promissory note that they're going to pay you a coupon, let's just say 2 or 3, 4% per year, right? So you're lending them money, and so it's a loan. A bond is a loan to the company. Stock, you're buying a piece of the company. So stocks are higher risk because companies can go up and down, fluctuate a lot in value. They can go into business. If you own the stock, you might end up at zero. If you own the bonds, likely you'll get something even if the company goes out of business because there's assets there. So bonds are less risky, therefore they don't pay as much. It's a loan to the company. There's government bonds, there's corporate bonds. Within corporate bonds, there's investment grade, which have more collateral behind them. Then there's high yield, less collateral, higher return, higher risk, that kind of thing. Government bonds pay less, they're less risk. Corporate bonds pay more. High yield bonds pay even more. They're typically perhaps smaller companies. The biggest companies would be investment grade. Enough said on bonds. Bonds are also known as fixed income. So when you hear the term fixed income, it's just essentially bonds for the most part. Then you get into commodities and futures. And you don't hear about that very much when you talk to a typical financial advisor. But you hear that when you talk to me, because the commodity and futures market is just as big or bigger than the stock market. And you can actually invest in commodities and futures through the stock market. I like to do that because that diversifies a portfolio. But commodities are the things that we know about. Oil, like I said here, gold, silver, wheat, you've heard of pork bellies, lots of different types of commodities. And then futures is just an extension of commodities. Futures includes all the commodities, plus there's interest rate futures, there's currencies, things like that. Those are futures. Essentially, they call it the futures market. Sometimes they call it the commodities and futures market. Then real estate. If you buy a house, you're an investor in real estate. You can speculate in real estate. You can buy a fixer-upper, a flipper. Some companies make bigger commercial real estate projects available for individuals. Those are typically limited partnerships, but real estate is another investment that you can do. Managed futures, similar to the futures market, but it's a very specific sector. I like managed futures. The Yale Endowment Fund, which is the most successful university endowment fund, likes managed futures. For the same reason, I like managed futures. Managed futures is systematic trading of the futures market, so it's like a more conservative subset of the futures market. And the idea of managed futures is they're not stocks, they're not bonds, they're something completely different that don't go up and down at the same time as stocks and bonds. So you diversify your portfolio, you smooth the ride by having some managed futures in there. I'm not advising that, I'm just talking about different types of investments. The reason why managed futures are so attractive though is historically when the stock market goes down, managed futures are usually the best performing sector or asset class. That's why people like it. They're kind of portfolio insurance. And the big category is mutual funds. As you can see, there's a lot written here. A lot of different types of mutual funds out there. All the different types we've talked about so far you can get within a mutual fund. So there's stocks, which is also known as equity. There's fixed income, bonds, also known as bonds. Balanced mutual funds, balanced funds, stocks and bonds. There's geographically focused mutual funds. You can buy a China fund or an India fund, South America fund, and both stocks or bonds are balanced. So that's geographically focused. You can say style focused, which is kind of a confusing term. Style focused. Style could be in small companies, mid-sized companies, large companies, growth companies, value companies. Don't worry about what that means right now. Just different types of funds. GARP is a funny term, but you'll see it out there. GARP is growth at a reasonable price. So kind of encapsulate a whole bunch of those within one. GARP, growth at a reasonable price. So many portfolio managers use that GARP style of portfolio management. There could be sector funds, for example, precious metals, oil and gas, lots of different sectors. Could be commodity focused. And then there's index funds. Index funds is a very important term to understand. Index funds are, for example, the Toronto Stock Exchange. There's an index, TSX index, which is the 300 biggest companies in Canada. You can buy an index fund that duplicates that market. Essentially buys all, for the most part, buys all the companies within that market. The most popular index fund in the world is the S&P 500. The most popular index in the world is the S&P 500. And actually, I thought I was going to include a chart on that, but maybe not. S&P 500 is the biggest 500 companies in the U.S. Then you have ETFs, which are exchange-traded funds. ETFs, a lot of them are index funds, but I won't get into any deeper than that. There's lots of different types of ETFs. Similar to mutual funds, but they're bought and sold differently than mutual funds, but a lot of similarities. Then there's hedge funds. And hedge funds is a bit of a misnomer. It's not well understood. I like hedge funds because there are some lower risk hedge funds available. There's also high risk hedge funds available. Historically, hedge funds are only available to accredited investors, which are the wealthier investors. They have at least $200,000 a year income, $300,000 with spouse, or $1 million of liquid investable assets, or $5 million net worth. You didn't need to know all that, but the bottom line was, in the last 2-3 years, the regulators made the lower risk hedge funds, not the high risk ones, but the lower risk ones, available to everybody. So now everybody can participate. So hedge funds, I won't get into details, but there's different types, as you can see on the screen. Long short, market neutral, special situations, arbitrage. Those are the general. The most popular one is the long short. The shorts are, a short is when you sell a stock first, hoping it goes down in value, hoping to buy it back later. How do you do that when you don't own it? That's kind of beyond the scope here, but you can. So the idea of hedge funds are you own some stocks long, which means I hope they go up in value, and you sell some stocks short, which means I hope they go down in value. So the hedges are the shorts. The market goes down, the shorts make money. The shorts reduce the losses. Now market neutral, the longs and the shorts are always equal in weight, so the market swings can't hurt you. Market goes up, the longs make money, market goes down, shorts make money. And if they're in equal weight, these market neutral funds, some of them are tremendous. The market swings don't hurt them. And if the portfolio managers are picking the stocks well, then they do well for relatively less risk than the stock market. Options are another one, which I won't get into details, but you can buy an option, for example, that say, I want to buy this stock at this price at some point in the future, and someone will sell you that option. You don't have to buy the stock, you just buy an option for roughly 10%. It could be a lot different than that, but roughly 10% the price of the stock. You now have an option to buy the stock at a certain price in the future. That's an option. There's other different kinds of options, but that's the basic one. Okay, enough on that. Types of investments. Investing fundamentals. Oh, there's the one I wanted to show. We'll get to that one. Very interesting chart. Most investment portfolios are 60% North American blue chip stocks, 40% North American blue chip bonds. The vast majority of investment portfolios are that way. Most balanced funds that we buy in Canada are that mix. Whether it's a portfolio of individual stocks or mutual funds or ETFs, the net of it is 40% blue chip stocks, North American stocks, 40% bonds. It's a traditional 60-40 portfolio. I tell you that just to be aware of it. I've seen hundreds and hundreds of portfolios over the years. and that's what they end up as. So in my opinion, that's not enough diversification for current market conditions. As you'll see when we get to the Shiller price to earnings of the S&P 500, price to earnings of the stock market is in nosebleed territory right now, which means it's kind of overdue for a major correction. Not very exciting if you own a bunch of stocks. Bonds, interest rates are so low right now that bonds have this interest rate risk. If interest rates go up, it hurts the value of bonds because people don't want those bonds that pay less if the newer bonds pay more. So the older bonds lose value. And they can lose a lot of value if interest rates jump up a lot. So that's why, in my opinion, the traditional 60-40 portfolio of North American blue chip stocks and bonds is not a great one for this time in the economic cycle. And I'm not giving advice because I don't know your situation. I'm just telling you that's the broad generality. So there's not much diversification there. So there's no hedge funds, typically. There's no managed futures. There's no small and mid-sized companies represented. Very little geographic diversification or active portfolio management. Why is that? Well, that takes time. Everybody's busy. Everybody wants to get more business in the door. They don't want to take a lot of time, human nature, on portfolio management. So the first level, I'm just going to touch on a couple of buzzwords here that you can carry forward and refer to going forward. Diversification and active management, those are two very, very big buzzwords that I'll encourage you to take away today and delve into going forward. Talk about it later. So the first level is active management, is looking at the price-earnings ratio of the broad stock market. Diversification we talked about already. Now we're going to talk about active management. So I'm going to see if I can go to this website, and I have a feeling that I'm going to need to shut down the PowerPoint again. I apologize. See if we can do it faster this time. Hey, how about that? Save a little bit of time. Now we're just waiting for the internet. So this is a very, very helpful slide, a helpful website. This is the Shiller price to earnings. It's very popular. There's lots of different types of price to earnings measurements. This is the Shiller price to earnings that goes back to 1870. It's the price to earnings ratio of the broad stock market in the US. So the stocks themselves have a price. Individual companies have a price. Together, those 500 companies have a price. Add up all the prices. Together, they have earnings. Add up all the earnings. So this is the price versus the earnings, price over earnings, of the broad stock market in the US. The long-term average price to earnings, you can just look at it on this chart. This chart picture speaks 1,000 words, is roughly 15 to 17. It's a ratio, price to earnings of the stocks in the US, the 500 biggest companies in the US. Long-term average is 17. Where is it today? This is right now. It's today, right up to date. It'll actually say down below here the date, but as you can see, current Shiller PE ratio, 39.11 as of Monday, August 30th. Oh, there's the mean, 16.85. That's the average, right? Median, 16. There you go. Long-term average, 16 or 17. Where is it today? 39. More than double the long-term average. A lot of economists talk about these days. The price of the broad stock market, the prices of those big stocks could go in half, and it would still be higher than the long-term average. What does that tell you? It tells you should not be very excited, or you should be very, very careful if you own stocks. That's all that means. And so you end up having to say, okay, well, what else can I possibly invest in? Well, we have bonds, right? We talked about that. Then we have a lot of other things. We have hedge funds. We have certain sectors, I won't get into it today, but commodities and precious metals. When inflation is high, which it is, precious metals and commodities typically do better. So those are just a couple of ideas, a couple of concepts. So that's enough on that one, but that's a tremendous slide, if you will, or website. I talk about it all the time. Oh, I think I hit the wrong button. What do we have going up there now? Okay. That's not very good. It looks like it's hung. So I'm going to have to open another one up. Another copy. Sorry about that, guys. That button I hit was just file. That shouldn't have happened. Okay. Close them both. Here we go. That looks better. Okay, I won't hit file this time. We will hit slideshow. Here we go. Here we are. Okay. So we can reduce risk and improve average returns. Referring to that price to earnings chart, we can reduce risk and improve our average returns by paying attention to diversification. We touched on that. Cycles, stocks, cycles. That's the price to earnings. That cycle that we just talked about. That's the stock market cycle. Commodity cycle. There's interest rate cycles. Being a little more active, or finding an investment advisor who touches on these things and tries to make improvements in this way. And lastly, that's related to active management. Diversification, active management, those are the big buzzwords. Part of active management is following these cycles. As I said, most people need an advisor to help them do this. Unless you feel particularly interested and wired to do this, it'll take a few years to figure it out, but you can do it. Types of advisors. Most people aren't aware of this, so that's why I'm touching on this one. There's financial advisors and there's investment advisors. They're different. The term financial advisor used to be known as financial planners. Those terms are interchangeable. They're licensed through the MFDA, Mutual Fund Dealers Association of Canada. They're licensed to sell and advise on regular mutual funds. That's the financial advisor. Investment advisors are licensed through IIROC, Investment Industry Regulatory Organization of Canada. They're licensed to sell and advise on all mutual funds, specialty funds, stocks, bonds, ETFs, hedge funds, options, REITs, limited partnerships, etc. I'm an investment advisor. I'm not boasting. Try not to. How and where to invest. This relates to the previous slide. We can invest through a bank. Generally, the advisors in banks are MFDA licensed advisors, therefore selling mutual funds. Often the banks own proprietary mutual funds. Not always, but generally. Or a mutual fund dealer, which is MFDA licensed financial advisor. Discount brokerage / investment firm, if you want to do it yourself. Those are available. Full service brokerage / investment firm. Those terms are interchangeable. Brokerage firm, investment firm, same thing, same term. Types of accounts. We've touched on our RRSPs and we've touched on TFSAs. But these are essentially, for the most part, all the types of accounts that you'll find that you might have to deal with in your lifetime. If you just have a cash account, that's a non-registered account. TFSA is where people typically get started. Tax-free savings account, you don't get a tax deduction when you invest in your TFSA, unlike an RRSP where you do, but all the growth in your TFSA is tax-free. So all withdrawals from a TFSA are tax-free. Right now, the maximum contribution for everybody is $6,000 per year. And I think if you were old enough and you started at the beginning of TFSAs, I think the maximum is about $76,000 that everybody's capped for your TFSA. RRSPs, often your employer will create a group plan, RRSP plan. You can do your own. And definitely those are the two tax advantage accounts that the government makes available to us. I definitely encourage you. It's standard wisdom, standard practice advice. use your TFSAs and RSPs. It'll create more money at the end of the day, at the end of your investing life. And then RSPs, well, I better touch on LIRA. LIRA is a locked-in retirement account. It typically happens if you had an RSP, a group plan at a company, and you retired, or retired early particularly, then you could take your RSP group plan away, and that becomes a LIRA, a locked-in retirement account. RSPs and LIRAs are essentially the same as far as how they operate. Once you turn 71, RSP becomes a RIF, a LIRA becomes a LIF, Life and Income Fund. All that means is those accounts change such that you have to withdraw from them each year as you get older from age 71 going forward. It starts off at about 5.3% per year, and it goes up. If you get into your 90s, it'll be something like 9% per year, something like that. So the government, and of course that becomes income, the government gets their taxes. So they gave you a discount going in, they tax you when you withdraw. RSPs and LIRAs, RIFs and LIFs. So that's enough on types of accounts. Hey, that's it. We have time for questions when we break into our small groups. So this is the most important part, we think, of launch class, is the small group time. Because in small group time, you get to practice talking about and asking questions around your table. So you have a coach at your table, you have some other students at your table, and get practice talking about these things, articulating these things, asking questions. I'll be around, I'll be walking around. Take turns sharing with each other what you liked about today's session, what you thought was interesting, more importantly, what you can apply, what you think you can apply over the next week or two. Because what we'd love to do is help each other, encourage one another to make a step in the right direction for each of these lessons. What did I learn? What can I apply today to improve my life, my family's life, my future today? So what steps will you take this week? Tell somebody. So the next time we get together, we can ask each other, how'd you do? How'd you do? And celebrate the success. Lastly, or thirdly, can you think of anyone else who might benefit from this message? Perhaps share it with them. We encourage all of us to be on the team, the mission to improve our society. That's what Launch Class is about. We want to help you be more successful, so your family's more successful, and then you can duplicate that. Pass it on, pass it on. Grow yourself, tell others about it. Next week's lectures will be in 2 weeks. Check the website or register on the blog, or register on the website to be notified for blog updates. So thanks guys, let's break for the second part. Really appreciate you.